So Ren, as you said in the opening, I want to do a segment called Beware the Pre-IPO ETF.
Okay. Now, this is popping up on your Instagram. You're being targeted by a lot of ads.
Yeah.
But before we get into why we should beware it, let's start with what it is.
So as we know, fewer and fewer companies are IPOing each year. They're all being scooped up by private equity or just staying private for longer. Major frustration of ours as retail investors.
Yeah, it means the opportunity set for people like us is shrinking.
Yes. What is then the result of that? There seems to be a trend now emerging where these startup businesses or active ETFs are coming to town and saying, we have access to all of these private companies. We're rolling them up into funds that are for the retail investor. Invest with us, get access to SpaceX, get access to Stripe, get access to these private companies that should be IPOing but aren't.
Canva,
yeah. You name it.
And the reason that they can get access to these funds, to these companies, is because there's like highly functioning grey markets for a lot of these stocks.
Yeah, secondary markets.
Yeah, because they're so big.
Massive.
And there's so many investors and employees that have shares. All these companies have an incentive to offer some form of liquidity. Now, some may argue that the best way to offer liquidity would be to IPO, so we could all participate, but they all have their reasons why they don't want to, mainly because being a publicly listed company is a headache. And so they do things like every quarter or every year, they'll set a price and the company will be the buyer, or they'll line up a buyer in one of the big funds and people can buy and sell. And so these shares are traded. They're just not traded in a way that's accessible for us.
Yeah.
And that's the selling point of these pre-IPO ETFs.
Yes. Yeah. So it seems enticing. I'm getting pumped with one at the moment, and I don't know if you are, but I've just seen it a lot. I've also heard it on a bunch of podcasts that I listen to. Instagram.
Honestly, all I get pumped with these days on Instagram is cooking videos. It's so annoying. So no investing.
Are you head chef at home?
I guess so, yeah. Alice probably would disagree. Yeah, I guess so.
But why cooking videos?
I think because I'm normally on the Equity Mates account, and I sometimes send them to my personal account if I want to look at them later. And so their Instagram is obviously like, this guy loves cooking videos, and it's non-stop.
Yeah.
So that's my way of answering that I haven't seen.
There's one particularly that has been doing the rounds on my social feeds. It's a company called Destiny, and their ETF is called Destiny Tech 100.
Okay.
The ticker is DXYZ.
Is it listed in America?
Yeah. Listed in the States. Now, they claim that they have access to they're creating an investment portfolio of the top 100 high-growth tech companies in the world, unlisted. You then go onto their page and you can have a look at their holdings. 36% is in SpaceX, 9% in Axiom Space, 4% Epic Games, 3.5% in OpenAI, 3% in Instacart. Then the list goes on: Stripe, Klarna, Impossible Foods. Some pretty big, enticing names in there.
Yeah. Also, FYI, Instacart is listed.
Yeah, I knew. I thought that as well.
But recent IPO.
Yeah, it would have been in there.
I mean,
Pre-IPO.
Look, if you were to say what were the companies I would expect to be in there, those are the companies. Yeah. I would have also expected the Chinese tech giants, ByteDance and Shein.
Yeah.
And I would have expected to see Canva as well, But yeah, like SpaceX, Stripe, Impossible Foods, OpenAI. The weightings are interesting. I would have expected a bigger weighting to OpenAI and Stripe.
Same.
Yeah. But so far,
so good.
Pretty fair. True to label.
True. Yeah. Well, that's where that's where I was like, okay, this is interesting. What's the catch? Because I was like, look, I could see myself getting a bit enticed with this. You dig underneath, 2.5% management fee.
Oof.
Yeah, so it's pretty expensive, but you're kind of like, is it justified given the companies, the access that you're getting? Maybe, maybe not. They claim top 100 companies, but the portfolio only actually has 23.
Okay, fair enough.
But Ren, where it gets, I think it's a no deal for me is in its construction, because it's a closed-end product, meaning that when you are buying and selling, you're not trading in and out of units.
Do they call it an ETF? They can't, because that's the whole point. An ETF is an open-ended
They call it
product.
an exchange-listed portfolio.
Oh, that's sneaky. That's sneaky.
Yeah, an
The
exchange.
old ELP.
Yes, an exchange-listed portfolio.
Yeah, okay. Because a closed-ended product for Australian investors is a listed investment company, an LIC.
Yes.
And so you have the problems of discounts to net asset value.
Yeah, there's no relationship. You're not buying in and out of net asset value. You're just trading the stock.
Yeah.
And so the price is driven by the market dynamic. The price is not driven by the underlying performance of these companies. And so when I had a look at the NAV, it's crazy. As of their most recent reporting in March, net asset values of $50 million.
Okay.
But it's trading at a market cap of $150 million.
No way.
Yeah. So, mind you, when this company IPO'd, it got to close to a $600 million market cap. Yeah. So everyone's getting super excited with this.
Oh, no wonder they're doing all their advertising.
I know. And so this is the point. Like, you come and you think, okay, I'm going to get access to these companies, but you're actually just trading on the hype of it. You would be buying into this hoping that the advertising on Instagram works.
But okay, in their defense, the biggest problem Australian investors have with listed investment companies is they all trade at a discount to net asset value.
True.
And everyone looks at Jeff Wilson as this savant, marketing savant, because all of his listed investment companies trade at par.
Yeah.
These guys are trading three times their net asset values. So move over, Jeff Wilson. Get these guys advertising.
True. It is a marketing game. So I guess, though, to take it back to like the fundamentals of investing, though, if people are sitting there going, oh, great, well, it's trading at a premium, like you don't want that, because you're effectively paying 3 times more for the underlying assets.
Yeah.
So you don't want to be doing that.
No, this is not a good investment. I know we don't give investment advice here, and general advice only, but I can't see anyone's personal financial circumstances aligning with paying 3 times these pre-IPO stocks.
No.
Especially because so many of them, their last funding rounds probably were not at the values that a public market would value them at. Often these funding rounds are quite inflated, and then they're using that value and they're still trading at 3 times that value.
And if you do the digging on Destiny Tech 100, you can actually see what they bought in at some of these companies, and massive write-downs already.
Stripe has had a massive write-down since it raised. I imagine SpaceX has had a small one, but the 2 most salient examples of this are Instacart and Reddit. What they raised at on the journey, and then what they're trading at now in the public markets. Yeah.
So buyer beware. If you see these things pop up and you feel like it's great, I'm finally getting access to these awesome companies, do the work and actually have a look under the hood. My suggestion is, if you do, there are actually some legit fund managers, albeit unlisted themselves, that are out there, still have pretty meaty minimums, but there are ways to get access to some of these unlisted guys.
I guess my concluding thought on this is there's plenty of ways to make money in the market. And obviously these names are sexy and exciting and changing the world in different ways, but you don't need to chase bad opportunities to invest in them.
Yes.
And to be honest, a lot of the value is maybe already there until they have their next round of innovation or their next leg of growth. So, just because Stripe has changed the way that we do commerce on the internet doesn't mean it's going to 5x or 10x from its value today.
That's true.
So I'm going to be a user of their products. Hopefully one day I'll be a user of a SpaceX and an Axiom space product. But I could live a long and happy life never investing in their stock.
Well said.
Equity line.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.